How do Ijara profit rates differ from loan interest? Imagine you're renting a car versus buying one with a loan. Both involve payments, but the way they work is very different. When it comes to Islamic finance, understanding how Ijara profit rates differ from loan interest is key. In an Ijara agreement, a financial institution buys an asset like a building or equipment and then leases it to you. You pay rent for the use of that asset, and this rent is called a profit rate. It is usually shown as a percentage of the asset's value. But this is not interest. It's a payment for the benefit of using the asset, not a charge on borrowed money. In contrast, a loan interest rate is a percentage of the money you borrow. You pay this interest regardless of how well your business or project performs. It is a cost for borrowing cash, not for using an asset. The main difference is the nature of the payment. Ijara payments are rental fees for the use of a tangible asset. You pay for the benefit of using the asset during the lease period. Loan interest is a fee on the borrowed money itself, not linked to any physical item. Another difference is the underlying asset. Ijara always involves an asset that the financier owns and leases to you. The profit rate depends on this asset. With a loan, there is no physical asset involved. The interest is just on the money lent. The way profit or interest is calculated also varies. Ijara profit rates can be expressed as a percentage, similar to interest rates, but they reflected rental income. Sometimes, these payments are structured to gradually transfer ownership of the asset to you, like in lease-to-own agreements. Loan interest, however, is usually fixed or varies with market rates, but it's always a percentage of the remaining loan balance. Islamic law requires that Ijara contracts avoid riba, which is interest. Instead, they promote risk sharing. The financier shares in the ownership risks of the asset during the lease. If the asset loses value or is damaged, the financier bears some of that risk. With a loan, the borrower bears all the risks, and the lender earns interest regardless of the outcome. Ownership transfer is also different. In lease-to-own Ijara agreements, you can gradually become the owner after making regular payments. With a loan, you own the asset from the start, but you pay interest on the borrowed amount. Profit rates in Ijara may be linked to a base rate plus a fixed margin, similar to floating interest rates. But these are rental payments, not interest charges. Loan interest rates can be fixed or floating but are always a charge on the borrowed money. So, while both Ijara profit rates and loan interest rates are shown as percentages, their legal and ethical foundations are very different. Ijara aligns with Islamic principles by avoiding interest and sharing risks, while conventional loans are based on interest, which is prohibited in Islamic finance. Understanding these differences helps you see why Ijara is a popular alternative for those seeking Sharia-compliant financial solutions.